is 2 in the morning and the library is nearly empty. A college student is staring at a blank document, completely stuck on a brutal chemistry assignment, with a deadline looming at dawn. This image shows dense, handwritten step-by-step calculus derivations. When you are staring at a multivariable equation like this, the friction is absolute. You either know the exact logical sequence required to solve it, or you fail. For over a decade, there was a universal solution to this specific problem. You didn't email your professor or wake up a classmate. You opened Chegg. Students handed over $14 a month because they needed certainty. They were purchasing a midnight lifeline that promised immediate, correct answers when all other options were exhausted. By positioning itself as the only frictionless exit from an impossible academic bind, the company built an empire monetizing pure student desperation. To ensure they always had the answer, Chegg spent 10 years paying human experts to manually solve and verify millions of textbook problems, storing them all in a massive database. This defined the retrieval era of the internet, a model where a company spends capital to generate a vast repository of correct information, places a toll gate in front of it, and charges users to access those pre-written answers. This chart shows Chegg's pandemic growth. The company swelled to 8 million subscribers, reaching a $12 billion valuation. Analysts viewed this proprietary database of human-verified solutions as a protective moat. Competitors would need a decade and hundreds of millions to build a matching repository. That $12 billion valuation relied entirely on a single assumption, that expert knowledge is highly expensive to generate, and therefore highly profitable to gatekeep. The sudden release of ChatGPT in November 2022 acted as a violent disruption of that exact assumption. ChatGPT moved the industry into the generative era by changing how information is synthesized rather than simply stored. This diagram shows the mechanical difference. The left retrieval method requires a $14 subscription to search a static database for a pre-written match. The right generative method takes exactly 3 seconds to synthesize a custom novel proof and costs $0. ChatGPT satisfied the same urgent need state of the student while entirely stripping away the financial barrier. The migration followed the path of least resistance. For students on a budget, the transition from a paid necessity to a free alternative was immediate. Inside the company, the fallout was swift. Subscriber counts plummeted, forcing severe corporate layoffs as the core revenue stream evaporated. This chart tracks the resulting financial destruction. By 2026, the market value of the company had dropped by over 90%. A multi-billion-dollar business moat built over a decade with expensive human labor became a fatal liability the moment the underlying technology shifted. Today, Chegg is in a scramble to survive. The once dominant monopoly has been reduced to a severely diminished firm, fighting to find a place in a landscape that has moved past it. But viewing this as an isolated failure misses the point. The collapse of this specific business serves as a glaring warning for the broader tech sector. It proves that the old model of locking aggregated human knowledge behind a paywall is over. Holding a monopoly on past human answers holds zero market value when a machine can generate a custom solution on demand. If a business model relies on acting as a toll booth for information, an AI chatbot can dismantle it in the time it takes a single class of students to graduate.
The Flywheel Empire. Engineering Chegg's monopoly.
To grasp how quickly Chegg collapsed, we have to look at the sheer scale of the empire they built in the first place. Back in 2005, they ran a straightforward physical business. They rented out heavy, expensive college textbooks, saving students hundreds of dollars a semester. But moving boxes of paper across the country carries severe logistical limits. You have to maintain warehouses, deal with shipping delays, and constantly manage degrading inventory. Renting books solved a real financial problem, but it left the most durable, renewable source of college anxiety entirely untouched: the sheer terror of failing a midterm. To reach massive scale, they realized they had to step out of the physical supply chain and sell the one thing every student desperately wanted: academic certainty. They shifted their focus to digital services, launching a platform called Chegg Study. This new platform created an entirely distinct pipeline, engineered specifically to capture the massive, anxious education market. The pipeline started whenever a college student got stuck on a complex homework problem. They would take a picture of the unanswerable question and upload it to the site. That specific question was immediately routed to a massive, manually operated network of hired subject matter experts, heavily concentrated in India. These workers would review the problem and write out a highly detailed step-by-step solution, usually returning it within a matter of hours. Once completed, the final step was simple: place that newly generated answer safely behind a digital subscription paywall. By connecting raw student desperation to offshore labor, Chegg manufactured a highly predictable, recurring revenue stream. This empty diagram represents a flywheel, a business concept where a self-reinforcing mechanical loop drives hypergrowth. For Chegg, this loop became an unstoppable engine. Stage 1, hiring experts turns a blank homework question into a permanent owned digital asset, an answer. Stage 2, those permanent answers index instantly on search engines. When another student inevitably types the exact same question into Google, they are pulled straight to Chegg. Stage 3, to actually see the answer, that new influx of students has to buy a monthly subscription, generating cash. And finally, the return stroke. That revenue is immediately reinvested to hire more experts, to solve more questions, and the entire cycle spins faster and faster. Traditional tutoring helps one person at a time, but here, every single time Chegg solved a student's problem, the entire company increased its structural value. Let that engine spin continuously for over a decade, and the volume of data it produces becomes almost impossible to comprehend. Look at this chart comparing answer banks. The tiny sliver represents a standard tutoring model. The massive spike next to it is Chegg's proprietary database, bulging with millions of hyper-specific, verified, step-by-step solutions. They had systematically hoarded the exact knowledge required to pass nearly every college class in the country. In economics, a competitive moat is the barrier that protects a business from its rivals. If a new tech startup wanted to Chegg down, they couldn't just launch a sleeker website or offer a lower price. A competitor would have to manually replicate millions of verified textbook answers, a process that requires spending a massive amount of money and a full decade of time. Chegg engineered an impenetrable, highly lucrative monopoly, tuned perfectly to a captive, endlessly rotating market of stressed students. And it's precisely that sense of invincibility that sets the stage for the sheer magnitude of their sudden collapse. For decades, the path through a difficult degree was paved with late nights and high-friction obstacles. If a student hit a wall with a complex derivation or a coding error, their options were limited to textbooks, office hours, or the help of a peer. Chegg stepped into this gap, capturing the vast majority of student traffic and building evaluation in the billions by digitizing the search for answers. Their empire was built on a proprietary vault, millions of textbook problems solved by human contractors and stored in a massive searchable database. In this era of education technology, market power belonged to the company that hoarded the largest collection of historical static data. But this architecture was limited to retrieval. The system couldn't think. It could only fetch files that already existed in its library. For a student, this meant mechanical friction. You had to type out precise search queries and hope that a human expert had previously uploaded the exact solution you needed. Access to this library was gated. To see the results of that search, students had to commit to a monthly subscription fee. The company's growth relied on the assumption that computers would remain digital filing cabinets, unable to calculate novel solutions on the fly. Chegg functioned as an aging digital library rather than a thinking engine, leaving it exposed to any technology capable of active reasoning. That exposure became a crisis with the release of large language models like ChatGPT. Unlike the systems that came before it, these models don't rely on a database of pre-solved human answers to function. They operate through generation. By mapping the logical frameworks of mathematics, physics, and logic, they derive answers from first principles. When presented with a problem, the AI doesn't search a file, it reasons through steps, generating custom, accurate solutions on demand. Almost overnight, the technological standard for solving problems moved from searching the past to calculating in the present. This shift in architecture immediately changed the user experience, offering a path with significantly less resistance. The old journey was defined by hurdles, paywalls, loading wheels, and typing complex searches. The new journey is built on ease. Paste a physics problem photo, receive an immediate step-by-step breakdown. Crucially, this faster, more capable alternative was available for free. In the tech industry, consumers will abandon a high-friction monopoly the moment a frictionless alternative proves it can solve the same problem. By the spring of 2023, the theoretical threat of AI manifested as a macroeconomic reality. During a May earnings call, Chegg's leadership admitted that ChatGPT was actively pulling away potential customers and impacting their growth rate. Wall Street's response was a clinical assessment of a company losing its competitive edge. In a single day of trading, Chegg's stock price dropped by nearly 50%. Investors were pricing in the sudden obsolescence of Chegg's core product. Business strategists use the term economic moat to describe a competitive advantage. For years, Chegg's static database was thought to be a deep one. But generative AI didn't cross that moat, it bypassed it. It made the entire concept of a database irrelevant to the act of solving a student's problem. This provides a warning for any business whose value depends solely on hoarding information. The requirement for survival has shifted. Companies must now pivot their architecture from static retrieval to dynamic generation, or risk losing their relevance to the market. In the age of AI, a library of static data is no longer a defense. It is an anchor. For a generation of college students, Chegg operated as an essential piece of academic infrastructure, deeply embedded in the modern university experience. The company built its empire around a defensible moat, a proprietary vault holding millions of verified, human-written answers to complex textbook problems. Ownership of this specific dataset allowed them to corner the market on student problem-solving. Accessing the correct answer required passing through their tollgate. Late in 2022, the arrival of generative AI threatened to drain that moat. Generative AI bypasses the traditional retrieval process. Rather than searching for a stored file, these models reason through the logic of a problem in real time. This shift creates a crisis for any multi-billion-dollar empire built on a static database. What happens when software no longer needs a library to find the truth? Chegg responded with an immediate corporate counter-strategy, moving to incorporate the very technology that threatened them. They struck partnerships with leading AI developers, seeking to integrate large language models into their existing platform. This effort culminated in Chegg, a proprietary AI companion designed to act as a specialized academic tutor. Chegg attempted to protect its market position by training these models exclusively on its vault of verified student data, betting that accuracy would preserve their premium status. While the execution followed standard corporate logic, the strategy failed to account for the changing math of the information market. The company faced a basic economic hurdle, competing against a free, frictionless alternative. Despite the specialized training data, Checkmate functioned as a paid gate on a commodity. Students found they could achieve similar results by using open models that didn't require a monthly subscription. As students migrated to free tools, Chegg's user retention dropped. This chart tracks the resulting trajectory. Revenue and retention entered a period of continuous decline through 2025 and 2026. To maintain operations during the downturn, the company initiated massive restructurings, resulting in deep workforce cuts across those same 2 years. When a dynamic tool is available for free, the economic value of a static paid database diminishes towards zero. Chegg's decline mirrors the trajectory of Nokia, which focused on its existing hardware dominance, while the industry moved towards software ecosystems. Similarly, BlackBerry prioritized the physical keyboard at the exact moment the market shifted to touchscreens. Chegg prioritized an archive of human answers, while the market shifted to synthetic reasoning. These failures weren't caused by a lack of effort. They happened because the structural advantages of the business ceased to apply. The collapse reveals a vulnerability for any company relying on a proprietary archive of human work. If an AI can replicate the logic behind that work, the archive itself loses its scarcity. Generative AI transforms historical data from a unique asset into a commodity that can be approximated by a well-trained model. Chegg is a signal of a broader shift. Any business model built on the exclusive control of past human output is now facing the reality of a world that can generate that output on demand. Silicon Valley businesses prioritize the moat, a structural advantage so wide and deep it creates a virtual monopoly. For a decade, Chegg served as the textbook example of a perfectly fortified moat in the education sector. The strategy was simple. Millions fed their homework into a centralized system, and Chegg held the solutions in a locked database. To access it, you paid a monthly toll. Rivals who tried building their own libraries were easily deflected. Chegg's library was simply too massive to catch up. But walls are designed to stop known threats. They offer no protection against a fundamental shift in the environment itself. Defensive infrastructure focuses on yesterday's rivals, often leaving a company blind to technological shifts that make their entire business model irrelevant. Large language models erupted across the digital landscape in late 2022. This technology didn't try to compete for Chegg's database. It made the concept of a static, closed answer key irrelevant. Traditional search relies on retrieval, finding a file in a drawer. Generative AI uses reasoning, calculating logic to construct unique solutions from scratch. This dynamic capability instantly devalued years of proprietary data. Why wait for human uploads when an engine generates one in seconds? Most corporate rivalries play out over decades. This transition occurred in a single semester. Disruption occurs when the rules change so thoroughly that the original leader is still playing a game that no longer exists. The shift hit Chegg's core metrics with a speed that shocked the markets. In early 2023, the company's valuation experienced a cliff-edge drop as students abandoned the platform for free AI tools. As the user base shrank, the feedback loop turned toxic. Less traffic meant proprietary data was less useful, which drove even more users away. Management attempted to pivot with projects like Cheggmate, integrating GPT-4 into their interface. But they found it difficult to charge a premium for AI-assisted answers when the underlying technology was already available for free elsewhere. Static defense mechanisms become a liability during rapid shifts. The same walls that once protected the revenue now prevented the company from moving fast enough to survive the new reality. Chegg remains a functioning company, but its position as a dominant, high-margin monopoly has vanished. This trajectory illustrates that relying on legacy infrastructure in an accelerating economy makes long-term stability fragile. Tech survival now requires fluidity. Companies must be able to adapt their core product as fast as the software environment evolves around them. The story of Chegg demonstrates how quickly the ground can move in Silicon Valley. It shows that no matter how deep the moat, technology can always find a way to drain the water. It's a lesson for the entire industry. The bigger your fortress, the harder it is to move when the world leaves you behind. Which companies rise and fall should we look at next? Let me know in the comments below. Hit that subscribe button, and I'll see you in the next video.